When my now 80-year-old grandfather bought his first house in his 20s, he could do so with a simple desk job, no degrees, and without any supporting income from his wife. When my mum bought her first house in the 90s, she did so without a university degree and no supporting income either. Now we've arrived in 2023, and people with a degree have trouble finding an affordable home, even with a supporting income from their partner. Housing prices have skyrocketed over the past 60 years, and although they've been getting lower due to increasing interest rates in the past months at the time of making this video, it's still not in the affordable range for many people, especially because of these higher rates. To quantify these stories, in 1960, the median price of a home in the USA was only $11,900, whereas the median family income was $5,600. And today in 2023, the median price of a home is about $430,000, whereas the median family income is only $74,580. That means the price of a home went up about 36 times in the past 60 years, while income only went up about 13.5 times. If you extrapolate these numbers into the future, and home prices keep increasing at the same rate, in 60 years the median price of a home would be over $15 million. I'm not saying anything about if this will happen or not, and chances are that at a certain point, home price inflation will be reduced, because well, otherwise no one can afford a home anymore. But still, if for a long enough period of time prices increase faster than salaries, the gap in absolute dollars between the two will grow exponentially because of the compounding effect. Having no affordable homes could affect more than only the fact that people have to rent all their lives, or buy a house that they might not actually want. It can detract from future perspective, cause civil unrest, and increase divide in our society. Owning a home can be a great way to pass on your wealth to the next generation too. When homes are unaffordable, it will make more people rent and pay off the mortgage of the owner of the house, instead of that of their own house. Persistent unaffordability can lead people to feel that the system is rigged against them. As property values increase, those who already own homes see their wealth rise, while those who don't are left behind. This widens the gap between the haves and the have-nots. But you may ask, what is the problem if you can still rent a home? Renting sure has its benefits. It offers flexibility, no maintenance hassles, and sometimes even included utilities. However, people feel that it's unfair they don't have the same chance of building up equity and having ownership of their own house. That, and if prices keep increasing significantly like in the past, renting in the private sector might become unaffordable for most people as well. This is already the case in major cities like Amsterdam, London, and Vancouver. There's much dissatisfaction in those cities about the high rents, and even people with high-paying jobs can hardly afford it anymore. This makes people spend all their money on rent and living expenses, which then affects their possibility to ever buy a house, because they can't save up money for a down payment. Okay, this might all be true, but when the parents of individuals that can't buy a home now pass away and leave their house to their kids, they might still have a chance to own a home, right? Well, maybe, in some cases, but you have to take into account that there might be an inheritance tax depending on the country you live in. You usually pay this tax over all the assets your parents own, even if they're illiquid. So when it comes down to it, you might even have to sell the house based on only this fact, but this really depends on your individual case. So how could housing prices get so out of hand? And is there any solution to this problem? The first thing that would come to mind is supply and demand. This is probably one of the first lessons of economics that you may have already learned before ever entering an economics class. In 1960, there were about 50 million homes in the USA, while there were 179.3 million people living in the country. There are currently about 241 million homes in the US, while the population is at about 340 million people. As you might already notice here, is that the amount of homes increased way more significantly than the population. However, these figures don't take into account which types of homes there are and the living standards people had compared to today. It's safe to assume that more people used to live in one house. People were often already married at a young age, so shared one house together, whereas living on your own might be more common now. In the 1960s, the dynamics of family living was quite different than what we observe today. During this period, it was not unusual to find extended families cohabiting under a single roof. This typically meant that grandparents, rather than residing separately, would share a home with their children and even their grandchildren. Such multi-generational households were a reflection of the cultural and societal norms of the time, where families were closely knit units that depended on and supported each other. Fast forward to today, and the standard has notably shifted. Multi-generational living has become much rarer in contemporary society. This shift is influenced by several socio-economic and cultural factors. For instance, the emphasis on individualism, the pursuit of personal careers and educational opportunities, and changing family dynamics have all played a part in redefining living arrangements. In the modern era, when elderly family members reach a certain age or require specialized care, they are often moved to elderly homes or assisted living facilities. This decision might be driven by their health needs, the demanding nature of modern lifestyles, or the lack of space and facilities to care for them at home. On the other hand, nuclear families, typically comprising parents and 1 or 2 children, have become the norm. The modern family structure, coupled with the preference for smaller families, has led to an increase of these smaller household units. Adolescents and young adults, driven by education and early career opportunities, frequently find themselves residing in apartments or dormitories. This is particularly common in urban centers and near educational institutions. Because of all these changes, while the rate of housing construction has seen an uptick, it has not necessarily outpaced the demand. This is not only due to the splintering of traditional family units, but also factors like urbanization, migration patterns, and economic factors that influence housing affordability. While the family structures and living arrangements have evolved considerably from the 1960s to today, the share it has in increasing home prices might be limited compared to other factors we'll discuss. But first, if you're interested in economics and like this video so far, please hit the like and subscribe button so we can educate you about more interesting topics within the sphere of economics. Thank you. Now let's get back to the video. Nowadays, real estate is seen by many as an investment vehicle. It hasn't always been like that, and the trend has had a lot of criticism over the past years. Low interest rates and easy access to mortgage financing increased demand of housing significantly throughout the last 60 years. But as you might know, when you borrow money now, you'll have less money later. Borrowing money costs money. At a micro level, it only costs the borrower money. But on a macro level, borrowing and increasing the money supply of this effect might cost society as a whole more money later. If the borrowed money is invested productively, for example, in assets that grow in value or in activities that stimulate economic growth, then the benefits can outweigh the costs. But if borrowing leads to unproductive speculation, asset bubbles, or unsustainable levels of debt, then there can be negative macroeconomic consequences in the long term. We all remember the 2008 financial crisis, which was centered around mortgage-backed securities, the housing sector, and ill-advised lending practices. Low interest rates and speculative investments led to a housing bubble. Subprime mortgages were common. They were handed out to borrowers with a poor credit rating, but had higher interest rates. With mortgage-backed securities bundling these subprime mortgages together, a new asset was created. The rating given to these securities was often not realistic. The leverage taken out against these securities meant financial institutions took a huge amount of risk on loans that had a fraudulent rating. As adjustable rate mortgages started to increase their rates, many homeowners couldn't afford their payments anymore and defaulted on the loan. This made the over-leveraged securities crash, and this eventually crashed the entire market. From the top in 2006 until the bottom in 2012, US housing prices dropped by approximately 30% on average. Certain areas, especially those that had experienced the most significant run-ups in prices during the bubble, for example Las Vegas, Florida, parts of California, saw even steeper declines, in some cases over 50%. Before the 2008 financial crisis, banks would literally call you whether you wanted to take out more loans. Nowadays, as a consequence of this crisis, getting a mortgage is increasingly difficult. But that's just if you want to live there, though. Someone that pays $1,200 in monthly rent nowadays often can't get a mortgage for a house that has the same amount in mortgage payments. However, if you'd have a down payment of 20% and wanted to rent out the same property, you'd still easily get a loan for that. In summary, the tightened lending standards, post-2008, And the different ways banks assess risk for primary residences versus investment properties can lead to situations where individuals find it easier to get approved for an investment property mortgage than a mortgage for a home they wish to live in. It seems like the willingness of people to take big risks to make more money fast, with the idea that the good times will never pass, didn't go away. One could ask, are we in a bubble again? A key hallmark of a bubble is that purchases are driven by the belief that prices will continue to rise, making it profitable to buy and sell in the short term. When a significant portion of real estate transactions are driven by speculative investors rather than individuals looking for a home to live in, it could be a sign of a new bubble. Unlike a stock, homes are a necessary commodity and is seen as a basic human right. Investors can take out leverage against a stock or index fund that might be extremely volatile, but taking out leverage against a home is way more interesting for many investors nowadays. It's surprisingly easy to get a 5x leverage on a rental property. This means that if an already rich investor has a $100,000 in cash, he can borrow an extra $400,000 to buy a rental property. Over time, the renters will pay back his mortgage payments plus profits, and there's a great chance the property will increase in value over time. Once there's a $100,000 paid back by the renters and the property value increased a bit, he now has the possibility to borrow an extra $100,000 against the same rental property, which he can use to borrow $400,000 again for yet another property, buying him another unit and accelerating the process. This makes rental properties a perfect asset with a great compounding effect, but it can also drive up housing prices significantly. And in this example, we don't even take into account the big institutional investors that invest with billions of dollars of other people's money and are willing to overpay just to increase their assets under management. There are massive funds with tens of billions of dollars under management that invest into real estate and can make their funds compound easily. A lot of this money even comes from pension funds. So the funds that should be taking care of you in the future are basically using your money to invest into real estate, which drives up prices and might make your future worse. This trend might still go sideways though. If the market is dominated by investors with loans that used to have low interest rates, they will get hit as the interest rates rise again, like we see happening today. They can then raise rents, but eventually their tenants won't be able to afford these anymore, which can lead to evictions. In some countries, you're not even allowed to raise rents indefinitely as the market changes. This means that these properties will have a negative cash flow, which leads to defaults with small-time investors. This could lead to lower prices again, but if interest rates rise, it could also still make them unaffordable. Chances are that big institutional investors and others with a lot of cash laying around will end up buying these properties. This is pure speculation though. All of the above would drive up housing prices on its own already, but construction costs have increased greatly as well in the past couple of years. Prices of materials were increasing so much that at some point, contractors didn't want to give out quotations anymore. They simply didn't know if the quotation would still be profitable enough next month. Houses don't build themselves, and unlike dollars, they can't be created out of thin air. To build a house, you need land, labor, and capital. The capital might be there, but if there's scarcity in the other two, this will create the problem that we see today. Today, when we consider the process of building a new house, it's crucial to acknowledge the significant evolution in rules and regulations compared to past decades. Specifically, if we turn back the clock and examine the construction landscape of the 60s or even the 90s, we would see a huge contrast in the regulatory environment. This transformation has been largely driven by a combination of safety concerns, technological advancements, and an increasingly urgent focus on environmental sustainability. There is a lot of land where houses could physically still be built, but because of zoning regulations and building restrictions, might never get a single brick laid on them. So I guess we can't blame greedy investors for all of our troubles. An array of circumstances increased the cost of housing and construction, and even if we'd want to build more, the amount of people that are willing to do the work is decreasing. According to a July 2023 CNBC article, the construction industry is short at least 650,000 workers. There seems to be enough money to build, but not enough people to do the job. There's a lot of money being allocated to projects, but not nearly enough to recruit and get new people into the industry. Sadly, construction work is not a flashy job, and there's even a stigma around the job. Where people look up to lawyers and doctors, people unfortunately look down on construction workers and plumbers, even though these are at least as important for society as the doctor and the lawyer. A lot of parents are pushing their children to college without even considering other opportunities that might be more rewarding. But that might be a topic for another video. So what's going to be the solution? Like many complex economic problems, there's likely not one silver bullet that can solve it. Multiple potential solutions could be implemented simultaneously, and they're not all dependent on the government. There might be things that you can do yourself as well to increase your chances of getting a house. An increase in the labor force would be a good start. Specifically, an influx of skilled workers in construction and related sectors can speed up the pace of house building, potentially increasing supply and making homes more affordable. This is simpler said than done though. More flexibility in zoning regulations for public sector housing might also be part of the solution. Oftentimes, houses in the public sector are way more affordable than homes in the private sector. However, the wait lists are so long because of high demand and low supply that there's often no opportunity for a lot of people to benefit from. Some advocate for the regulation of the private sector, where stricter terms are applied to the maximum rent that can be levied, or an extra tax for vacant places. We have to keep in mind that some regulations might have unintended consequences though. Do you think this problem will be solved in the near future? Or do you think that more and more people will become tenants instead of homeowners? Let us know in the comments. I hope you liked this video, and if you did, please don't forget to like and subscribe to our channel. Have a great day, and until next time.